Welcome back, everybody. Today we're going to talk about loans. As a startup, you need money to grow, so most of you need funding. The three most common ways to get funding are the following. You can get a loan, you can sell your shares for cash, or you can use convertibles. Today's film is about the first one, loans. Loans are easy, right? At least the concept of a loan is easy. Let's look at an example. Party A, a lender, let's say a bank, loans the money to Party B, let's say a startup. Let's make this your startup. Usually the lender lends the money in exchange for a compensation. The compensation in general is a percentage interest over the total amount. So in this example, if the bank lends $200K to your startup for 4% interest, then after 1 year you have to give back the $200K, the initial total amount, plus $8K, which is the interest. So the bank gets compensated for the risk in lending you the money. In general, it is very difficult to get a loan as a startup. Why? Well, basically, most startups fail. Let's suppose 1 out of every 5 startups fail. So a bank lends an equal amount to 5 different startups. Then how much interest percentage must a bank receive in order to break even on their activities? So no profit, just break even. From the bank's perspective, they should receive at least 25% interest to break even on their lending activities to startups, or else they lose money. This is because the 4 existing startups should compensate for the loss of 1. Now from your perspective, do you as a startup want a loan against 25% interest? I don't think so. And actually, the startup fail ratio is something more like 7 out of 10, or even 9 out of 10. So this example is still on the conservative side. In general, this is not a realistic business case for a bank. I suppose you could say, but the bank could get some collateral to make up for the gap. When you buy a house and get a mortgage, then the bank will loan you the money with the house as collateral. But what is the collateral in an early stage startup? Some second-hand computers and a wall with Post-its? Overall, if the startup fails, then the bank has nothing to recover. There are a few exceptions though, like patents, but this is the general rule. So in the end, this is why loans are so uncommon for early stage startup funding. When you see startup borrowing, it is often either a subsidized loan, so actually a subsidy, or it is a delayed payment of an invoice of some sort. With both of those, it is important to remember that a startup will struggle to have a lot of positive income, so these forms of debt can be quite dangerous. These may not be regular loans, but they could still force you to start making repayments in the future. Now, a sudden shocking requirement to make big cash payments can really disrupt your company and make you less attractive to future investors who are putting that cash into your company. So, if you wind up having this kind of debt, always make sure you have agreed that this can be repaid slowly and gently over a longer period of time that's less disruptive. So there, debt funding is not really your friend. So what do? Luckily, there are other funding options for startups such as convertibles and shares. To learn about that, watch our movies about the convertible and shares. We have plenty of other videos. Check them out. We hope you've enjoyed this video.